Why MF AUM to GDP, or for that matter, MF to bank deposit ratios are low in India, the reasons thereof, what investors actually want, and what their actual experience is. Hi, I am Umeshkumar Mehta, CIO of Samco Mutual Fund. I will be talking on our new Samco Dynamic Asset Allocation Fund. But first, let's begin with understanding why is ratio of mutual funds to bank deposits low in India? Fear. Yes, because of fear, investors are still investing a large part of their savings in traditional savings instruments. What kind of fear they have? Certainty of return of capital and not return on capital. They must get back their money when they want. But stock market returns have volatility, meaning appreciating NAVs and also witnessing falling NAVs. Drawdowns during falling markets. Simply put, मुद्दल कम होनी नहीं चाहिए. Original capital should not become negative. They want their money back anytime, and that need generally comes around during crisis or recessions. But equities have ups and downs. Proof, on an average, every decade, Sensex has fallen by over 50% in last 40 years. Even Dow Jones Industrial Average has fallen by, on an average, 50% in last 125 years. Which is why when equities form part of savings through mutual fund instruments, investors face those inevitable drawdowns, especially during bad times. This is one important reason why ratio of mutual funds to bank deposits is low in India, standing at 24%. This is also probably one of the reasons why India has one of the lowest ratio of mutual fund AUM to GDP, standing at just 16%, whereas the world average is huge, 63%. Thus, the main reason, the fear of drawdown of capital that keeps investors away from equities. Why balanced advantage funds, BAF, Dynamic Asset Allocation Fund, DAF, in hybrid category have drawdowns? On a lighter note, because they are slow. Industry experts and regulators, being well aware of fear psyche of average investors, they have thoughtfully brought the category of hybrid funds, BAF, DAFs, essentially with the purpose that drawdowns of equity is curtailed and at the same time adding kicker of equity returns in their portfolio. Happens the birth of new category, BAF, DAF. But actually, what has happened? Investors of BAF, DAF hybrid category have virtually witnessed the same extent of stressful volatility of equities as if he or she is hardcore equity investor. In 2001 drawdowns, as can be seen, up to 40% NAVs were down, and in 2009 drawdown up to 55% was experienced by the investors. The mental configuration of such investors is conservative, but embedding market drawdowns volatility in his or her portfolio gives an unpleasant experience. If we go to the root cause why in hybrid funds this is happening, it is because they are slow. Let me explain with two viewpoints. First, BAF, DAF in general have static asset allocation in equities and debt at 60-40, and rebalance happens with a lag. The allocation does not change with changes in markets. Teji mandi mein sab same. Second, almost all funds are following valuation models, meaning when markets are falling, more allocation to equities is made. But allocating more during falling markets is akin to catching a falling knife. All major drawdowns happen in falling markets, and one never knows how bad things can get and how low prices can go. and we have seen prices falling by over 50% once a decade. Thus, remaining invested due to static equity allocation and adding more during falling markets is the root cause of drawdowns, which many times even mimic Nifty 50 drawdowns. Even from rolling returns perspective, there is huge volatility as can be seen from the red line. 2001 negative 1-year rolling return of 35% and in 2009 negative return of 50%. What do people really want from BEF-DEF category? People generally want from hybrid BEF-DEF category 3 outcomes. First is lower drawdowns and volatility in their portfolio. Second, better returns than fixed income. And third, but most important, certainty of return of capital without big loss. Explain what is Samco DEF. Samco Dynamic Asset Allocation Fund, as the name suggests, offer 0 to 100 equity exposure during uptrends by investing in top momentum stocks from each of the large, mid and small cap universe, but quickly transform into 0 to 100% debt on the real time when the trend changes using proprietary transformer model to protect the downside, curtailing the drawdowns. How the transformer model changes from 0 to 100 equity and when time changes turns 0 to 100 debt. Let me explain transformer model. T stands for trends in equity market. Bhav Bhagwan hai. This is the most important part of model and strategically decides whether to remain in equities or move out. In order to identify primary trend of equities, analysis of slope and angle of prices is done, regression models and time series and cross-sectional momentum indicators are used to establish an uptrend or downtrend. The other 10 model constituents from after T, that is from R to R, are tactical in nature, which adjusts equity exposure for mean reverting opportunities during periods of extreme price move. For example, during market bottoms, although primary trend is down, but market breadth indicators will signal equity exposure, allowing transformer model to get into equity mode. During extreme price moves, for example, breadth indicators like percentage of stocks above or below 40-week averages. In 2020, this breadth indicator had reached extreme reading of 0, indicating entry into markets. Let me explain with one more example. Net 52-week highs, lows help to take mean reverting opportunities during extreme periods. In period 2009, number of stocks making 52 weeks low was falling, but market kept inching lower, indicating divergence and a signal to get into equities. Let me explain back-tested results when compared with Nifty 50 TRI. Obviously, this comes with standard disclaimers. 1-year rolling return since 2005. Blue line is Samco DEF transformer model returns and red line is benchmark returns. 3-year rolling returns since April 2005. Blue line is Samco DEF transformer model returns, red line is benchmark returns. Drawdown of model since 2005. Blue line is Samco DEF transformer models drawdown and red line is benchmarks drawdown. XIRR returns of Samco DEF transformer model since 2005 is 20.05% with low standard deviation of 12.74% compared to Nifty 50 TRI, which has returned 14.32% with 21.64% standard deviation. Disclaimer: the past hypothetical backtest results are neither an indicator nor a guarantee of future results. Actual results shall vary from analysis. What is investment strategy of Samco DEF? Basis the transformer model, once the extent of equity allocation is determined after considering strategically important trends in equity market plus adjusting for tactical factors of other transformer constituents for equity mode. Now the question comes, what to buy when in equity mode? Here, momentum strategy will be used to identify stocks from universe of large, mid and small cap category. For those times when transformer model signals debt mode, then a mix of AAA, AA plus, AA, GSEC having liquidity and optimum duration will be identified along with equity debt mispriced opportunity model, EDMO. Let me explain what EDMO is. It is generally seen that equity prices are a leading indicator flashing on the screens of the exchanges as millions of participants buy and sell stock. EDMO suggests that if it is worth buying a stock for investment, then it is worth buying its debt for investment. In certain instances, if the debt of a particular company yields more, other things being equal like rating, but the stock is fundamentally sound, then this is an opportunity to invest in such instrument which has higher yields. This is how dynamically equity debt exposure along with momentum strategy in equity and EDMO in debt will be managed by Samco DEF. What are the sources of alpha for Samco DEF? Let me explain 4 sources of alpha. First, zero equity exposure in bear markets. This is an important feature which helps in reducing drawdowns and volatility. This gives freedom to investor to use his or her capital during uncertain times and stands the chance to withdraw full amount of capital with limited drawdowns. The red dots are complete exit from equity and green dots are full entry back into equities. Second, 100% equity exposure in bull market. This adds the advantage of magic of equity returns in the overall portfolio, which otherwise is rare in hybrid BEF-DEF category. For illustration purposes, since April 2020, a 50% equity portfolio has delivered 72% return, while a 100% equity portfolio has delivered 183% return. Third, alpha from small cap and mid cap stocks. Historically, it is seen that mid cap and small cap shares have delivered better return propositions. Fourth, investment will be selected using momentum strategy from a universe of large, mid and small cap shares, which will offer superior risk adjusted returns while in equity mode of investing. Nifty 50 since 2005 has delivered 12.94% CAGR returns, whereas momentum has delivered since 2005 22.42% CAGR in mid cap space and 18.53% CAGR in large cap space. Why Samco DEF? It has MDDRS. Let me explain. Samco DEF offers momentum trend following strategy in equities when markets are in bull phase, and when markets changes or trend bends, offers drawdown protection during bear markets by getting out of equities and entering into debt arbitrage mode. The exposure to equity debt will be dynamic in nature such that the fund can transform real time into 100% equity to 100% debt and vice versa using transformer model without time lag. The system has built-in stop losses to quickly cut equity exposure, manage risk and protect drawdowns during tough times. For whom Samco DEF is recommended? Samco DEF is recommended for all investors and even first time investors who want to create long-term wealth with steady growth, lower volatility, downside protection with stability and peace of mind. Samco DEF will have no exit load for up to 25% unit and 1% for remaining units on or before 1 year and nil after 1 year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.